S&P put out a press release that they've granted, for the first time to a Bitcoin treasury company, a credit rating. So we were rated as a B-.
Is that fair?
It's a start. We expect to move up in the ratings over time, but we think it's a very auspicious start because it represents institutional adoption of Bitcoin-backed credit.
The world is changing, and Michael Saylor just confirmed it on CNBC. Bitcoin is no longer just digital gold, it's becoming the foundation of a new financial system. The same Wall Street giants that once mocked crypto, JP Morgan, Citibank, and Wells Fargo, are now preparing to issue Bitcoin-backed credit. Saylor calls it the shift from fiat debt to digital capital, a transformation unfolding in real time. Even the White House, the Treasury, and the SEC are aligning behind Bitcoin and digital assets. What we're witnessing isn't chaos, it's the birth of a new monetary era. From one company holding Bitcoin in 2020 to hundreds today, soon it could be every major corporation on Earth. This isn't just finance, it's a revolution in truth, trust, and time. If that shook you, like, comment, and subscribe for more insight from Michael Saylor. Now, let's get more from Saylor's insight. Listen carefully.
And of course, the most exciting thing we've done this year are 4 IPOs of 4 digital credit instruments: Strike, Strife, Stride, and Stretch of late. And now that we've got an S&P credit rating, that's going to open up the market. There are hundreds of billions, if not trillions of dollars of capital that won't buy an unrated instrument that can go ahead and acquire a rated credit instrument. So it's really a great day for us and for the entire crypto industry, I think.
And for the layman, how should they understand investing in MicroStrategy, you've rebranded since to Strategy, but investing in Strategy, the public equity, versus these 4 new product offerings you just mentioned?
Well, Bitcoin is the baseline, and so what you want is the digital commodity. You would buy Bitcoin because it comes without that counterparty risk, and that's normally been about a 45 vol asset that's returning about 45 to 50% a year. Our equity is amplified Bitcoin, so we actually have more volatility, more like 60, and we've been outperforming Bitcoin. So the people that want more volatility and they want more performance would buy that amplified Bitcoin equity. But there are a lot of people that want half and half. They want some of the upside, a lot less downside, and they want a dividend. And so that's what Strike was created for. It's convertible preferred that gives you long-term upside, but principal protection and an 8% dividend at par. And then there are other people that are long-duration credit investors. They buy things like Strife, which is a 10% dividend at par forever, like a 100-year bond or longer. And then for those that want extreme fixed income, they would buy Stride, because Stride is the junior credit instrument, but it yields about 12.5% effective yield, so about 350 basis points more than Strife. And the final one is Stretch. Stretch is a treasury credit instrument. It's for people that don't want they want the minimum volatility. Like, I have money I don't need for 6 months, and then I got to pay my kids' tuition, or I got to pay my taxes, but I don't want to get paid 2% or 3% or less from the bank. So Stretch pays a dividend, which is right now 10.25% at par. It's got most of the volatility of Bitcoin stripped away. It's kind of targeted at 100, and now it trades like 98.70 cents or something. So it's very close to that 100. And what you're getting there is equivalent to like a 1-month Bitcoin bond, right? So if you've got a short-term focus and you hate volatility, but you want to get paid double or triple what the money market would pay you, you would buy that Stretch instrument. And if you've got a massively high risk tolerance in your Bitcoin Maxi, you would buy the equity. And the other credit instruments are for people in the middle.
And talk to me about the nuance of it being a tax-free dividend yield that you're looking at here.
Yeah, well, the beauty of a digital credit instrument that's issued by a treasury company like ours is we fund the dividends by selling equity. And when you fund the dividends by selling equity, then the dividend becomes a return of capital. And as a return of capital, it means there is no tax on the dividend. So when you're getting 10%, you're getting 10% cash dividend yield. And what happens is your basis in the instrument is reduced by the cash dividend. So if you buy a $100 share and you get a $10 dividend a year, then your basis goes to 90, and then after the second year it goes to 80, and after the third year it goes to 70. But for the next 10 years, you have no tax. You don't pay qualified dividend. You don't pay long-term capital gains tax. You don't pay ordinary income. You just get a return of capital. So that means the tax equivalent yield of one of these instruments is like 16 to 20%. It's like a bank that pays you 20% interest. And so that's a very special thing. It's because we're built on Bitcoin. A treasury company built on Bitcoin is the most tax efficient fixed income generator in the world.
And I've seen this evolution of what you're doing in the Bitcoin industry. So 5 years ago when we started talking, it was very much about this digital asset treasury strategy, which we're going to loop back around to in a minute because so many people have been following in your footsteps there. But as of late, there's been this evolution into digital credit, which we've just been talking about. And we're here at a payments conference, but Bitcoin isn't about that payment element. It's not about the transactional nature of cryptocurrency. It is kind of about this dual structure of a credit offering. Can you talk to me about how your thinking has evolved in that?
I think the crypto industry has evolved over the past 12 months into two different sides. There's the digital capital side of the industry, and Bitcoin is digital capital, a long-term store of value, and digital credit instruments that are built on top of that capital. So we're accumulating the capital and we're selling the credit. On the other hand, there's digital finance. And the digital finance part of the industry is tokenized currencies, tokenized securities, tokenized brands. And that's all of the proof of stake networks and all the crypto exchanges and the stable coins and all the tokenized stocks and tokenized bonds and the meme coins. And that entire business is going through a Cambrian explosion of innovation as well.
And JP Morgan is now willing to accept Bitcoin as collateral. At least they said that they intended to do that. Talk to me about that component where you're seeing Wall Street banks lean into Bitcoin as collateral. What is that?
Yeah, I think the most exciting thing is 12 months ago, you couldn't get a loan against Bitcoin or a loan against wrapped Bitcoin like an ETF like IBIT. You couldn't get those loans from any major bank in the nation. And now what you see is that Bank of America, JP Morgan, Wells Fargo, BNY Mellon are all beginning to embrace this asset class. You see other innovative banks, Charles Schwab, Texas Capital, they're offering pretty progressive credit terms against either IBIT, and now even many of those banks are starting to talk about offering credit against underlying Bitcoin. I think in 2026, we'll start to see some of these major banks like Citi custody Bitcoin, BNY Mellon start to custody Bitcoin, and companies like JP Morgan start to issue credit against it. I think it's all very auspicious for the entire industry.
I was wondering when they were going to start doing that, because you saw the SAB 121 roll back, and I mean, we have the Genius Act passed into law, but that's not the crypto market infrastructure bill that seemed like it was what was standing in the way of banks getting comfortable with custodying crypto. But are they going to do that absent further hard and fast rules from Capitol Hill?
It looks like the train has left the station and now everybody's moving forward.
Are you pleased with what you're seeing out of Washington, from whether it's the White House or lawmakers?
I think the entire administration has been, and the Senate and the House have all been just very, very positive toward digital assets consistently for the past 12 months. I think we've seen a lot of very positive initiatives out of Treasury. You see enormous positive initiatives from the SEC, and now you see we've got a new designated head of the CFTC who's very positive on digital assets in the entire crypto industry. I think the White House could be more supportive. So I think that this 12 months has been probably the best 12 months in the history of the industry, because what you got was the White House endorsing Bitcoin as digital gold. Then you got the SEC saying we expect that securities will be tokenized on chain and we're going to support it. You got the Secretary of the Treasury endorsing stable coins and saying we believe that the future of the US dollar currency is to be tokenized and exported to the world, and we're going to support that. And now you've got a pro-crypto head of the CFTC. When you put that together with all the other cabinet members like RFK, like Tulsi Gabbard, like Howard Lutnick, et cetera, that are coming out with very pro-Bitcoin, pro-crypto initiatives, I just really don't think the industry could ask for much more.
It's been incredible to see what's come out of the SEC with respect to crypto-friendly policies or rollbacks of policies that weren't all that advantageous to the sector. You said the White House could be doing more. What would you like to see from them?
Well, I think that they've done everything that they need to do at this point. Most of the work to be done is going to be done by the banking establishment in the Western world. I think it's, at this point, the industry is going to 10x. It's going to increase by a factor of 10 based upon activities that are taking place at JP Morgan, at Wells Fargo, at Bank of America, at Morgan Stanley, at BNY Mellon. It's the big household brands at Citi, right? They're the ones that are going to introduce Bitcoin and digital assets to the next billion people.
This was the summer of the DAT trades, the digital asset treasury companies that kept springing up, whether it was holding Bitcoin or Solana or name your altcoin. What do you think of this? I mean, it's flattery or imitation, the greatest form of flattery is imitation, or whatever the phrase is. What is your take on all of these DATs? Is it a good thing for the industry? Is it oversaturated at this point?
I think there was only one company that was capitalized on a digital asset in 2020 when we did it. We were the first. And then there were about 10, and then there were 20, and about a year ago there were 60, and then there were 120, and now we're exploding to 250. I think it's indicative of the digital transformation of the capital markets. I think we're going to see 500 companies, then 1,000, then 2,000, then 5,000. Eventually, I don't know why every forward-thinking company wouldn't start to hold some digital assets on their balance sheets. So I think it's an idea as time has come. I think it'll be good for the entire industry, the digital assets industry. But I think it's also good for the 50,000 publicly traded companies that aren't capitalized on digital assets. It's like saying, well, I've noticed 250 companies have the internet and have a website now. How many, is that good or bad for you? And I think eventually every company has electricity, and every company has a website, and every company will have digital assets because there's smarter, faster, stronger ways to create shareholder value.
So many of my conversations over the last few days have been with traditional payment networks. So whether it's a Visa or an Amex, and the work that they're doing with the generative AI players, sometimes in the context of agentic commerce or other ways to just be a part of the cutting edge of what the financial stack looks like now. Where does cryptocurrency fit into that, or Bitcoin in particular?
Well, I think that if you look forward, you can see that there's 1 billion AIs that are going to want to do business with 1 billion AIs representing you and me and 8 billion people and 400 million companies. They're going to want to do that business at the speed of light. They're going to want to be trading 1 billion times an hour, not 1 million times a second. They're not going to have any patience for 20th century techniques. They're not going to want to wait for a week for a wire to be transferred. So I think it's inevitable that you're going to see stable coins, especially US dollar-backed stable coins, that are going to explode from it was a $100 billion business a year ago to 250 billion to 500 to $1 trillion to $2 trillion. Eventually, I think there'll be $10 trillion worth of stable coin moving at the speed of light, millions of times a second. And I think that that'll be the medium of exchange in the digital economy. And then I think the store of value, the capital asset in the digital economy will be Bitcoin. These AIs are going to want to capitalize on Bitcoin. If you want to release something into cyberspace and have it live forever, how are you going to capitalize it? You're going to load it up with some Bitcoin. The Bitcoin is going to continue to appreciate in value. So you don't need to be a person to own Bitcoin. And you don't need to be a person to move stable coins around. And one thing I'm sure is that people are not going to think as quick, and they're not going to be as smart, and they're not going to work as hard as the robots and the AIs are. So it'll be a digital economy on digital rails with digital currency and digital capital, and that again is auspicious for the industry, but also it's good for the human race.
I'd be remiss not to ask you about where the industry is headed with respect to the markets and the price charts and all of that. And I say that keeping in mind that we saw this huge surge in the price as we saw the spot Bitcoin ETFs come online and a lot of that institutional money flow in. And that was absent, to your point, the banks actually custodying the cryptocurrencies themselves, which has been seen as another potential unlock. These digital asset treasury strategies, also more upside, it seems, in the crypto in the crypto charts. Talk to me about where you see Bitcoin hitting at the end of the year and in a year from now when we're back at this conference.
Well, I think Bitcoin's going to continue to grind up. I think the volatility is coming off of it as the industry becomes more structured with more derivatives and more ways to hedge it. Our expectation right now is end of the year, it should be about $150,000. And that's the consensus of the equity analysts that cover our company and the Bitcoin industry right now. I don't know why it won't grind up to $1 million a coin over the next 4 to 8 years. I would think not less than 4, not more than 8. And of course, my long-term forecast is it goes up about 30% a year for the next 20 years, and we're headed toward $20 million Bitcoin.
Michael, thank you so much.
Yeah, my pleasure.